A week ago, I made the case for a bottom finally in the making for the stock market after 5 weeks of selling. It was a call that looked tentative at the time, but I saw the signs in terms of the market wasn't quite pushing down to the technical oversold level, which I'll cover in just a second. The announcement of a ceasefire that was supposed to open up the Strait of Hormuz, let the buyers run free. We had a huge gap up last week on Wednesday, and the buyers held their ground going into the end of the week. This is a key signal that tells us the market has already moved on from the tragedy, the destruction of this war against Iran. This is an important concept to get straight, particularly from the psychology of the market standpoint. Where the market is now, it's going to take something even worse before the market cares. Now, sure, we're going to have some pullbacks, some price consolidation, but there are going to be key levels that the market is likely to hold because it is now looking forward. It is just priced in, essentially, as they say, the worst that we have seen. What could be worse than what's already happened? Well, it's not going to be a resumption of the war. That's not going to be enough. It would be, say, for instance, and I'm just making this up, Russia joining into the war on Iran's side, or China joining into the war on Iran's side. Those would be truly worse scenarios that would probably get the market's attention and send us to a lower low. But let's hope that doesn't happen. Let's just hope that the market is right. We have seen the worst. Now, what's coming forward is earnings. So earnings season starts up. I doubt that earnings will have enough to upset this confirmed bottom. That's just my guess. And then what's after earnings in April? Well, then we go into May. You're going to hear all sorts of silly stuff about sell in May and go away. I've already written about this several times. Sell in May is an old adage. It doesn't apply anymore. We do get May through August, particularly starting in August. We have higher risks of drawdowns, but those drawdowns should be treated as buying opportunities. They should not be feared. Particularly not in this market. This market is bullish. And again, that's what's happened this past week, is that not only did we confirm a bottom, but the market returned to definite bullish conditions. All right, so I'll take you through the charts. In the meantime, please like and share this content so the algorithms know what's up. Subscribe to the channel if you want more content like this. And of course, if you have any comments or feedback, put them down below. All right, let's get into it. All right, got to start with oil. This is ticker symbol USO, the United States Oil Fund. It's a proxy for oil, for Brent, and for WTI. Here's one of the first clear pieces of evidence that the market is already moving on. Look, USO at the ceasefire deal dropped 10%, let's just call it 9.8%. And yes, that caused a lot of excitement. But look, the Strait of Hormuz isn't even really open. So oil is remaining elevated, and yet the market is still in rally mode. And it did not even come close to reversing its gains from Wednesday. So this is our first sign. This is the psychology of being oversold no more. It's buy dips. So oil is elevated, USO is elevated, and yet the market is also remaining elevated. That means the market has moved on. Let's take a look at my favorite technical indicator, the percentage stocks trading above the 50-day moving averages, what I like to call AT50 above the 50. Here's the technical oversold level, 20%. Like I said earlier when I claimed the bottom was in, I could not wait until AT50 got to this oversold 20% level. And it made this higher low, which was the signal to me. It made this higher low, and then the bounce after that told me, yes, this is a bottom in the making. And like I said, this big gap up, AT50 went from 38.5% all the way up to 49.8% in one day on Wednesday. That was a gain of, let's just call it 11 percentage points. That was huge. That is as clear of a sign of a bottom being put in as can be. Now, granted, AT50 did pull back a little bit today and ended at 50.1%. So we are right there at the 50% mark. 50% of the stocks are above the 50-day moving averages, 50% are below. That seems kind of appropriate for the place that we're in. I expect a lot of tug and pull, push and pull in the market, a lot of tug of war. We have earnings. There's going to be catalysts that make people happy, make them sad. We had the jobs report came in strong last week, the jobs report for March. When we have another jobs report, it could be bad again. And so we've had this seesaw effect on the economic front as well. And let's not forget that when we came into the year, there were all these positive catalysts that were pushing the market higher until the war happened. And those catalysts are now going to become part of the forefront. What am I talking about? I'm really talking about a lot of the fiscal stimulus that is being pumped into the economy. And if we actually get a rate cut, you can only imagine how the market would rally in the face of a rate cut, despite inflation remaining sticky. So all of those things to say is that we are now in that psychology of we're no longer oversold by dips. Okay. Now let's go to the percentage stocks trading above their 200-day moving averages, what I like to call AT200. You can see here it's cleared all of this churn, and let me just make it clearest with a little box here. You can see this was a big area of churn for AT200. And now it's cleared it. So it's cleared this box. What I don't want to see is AT200 get back into this box. So let's say it needs to trade above 50% for me to be careful, to be perfectly comfortable with the long-term health of market breadth, because it's the percentage stocks trading above their 200-day moving averages. AT200 closed the day at 52.6%. And you can see this unfortunate, what we call bearish engulfing pattern. I won't get into the technical details, but that suggests that AT200 could be done going up for some time. So this will be part of the push and pull in the market that I'm expecting in the days coming forward. Now let's take a look at the indices. Very powerful moves across the board. Here's the S&P 500. I mean, this is so powerful. It cleared with its on Wednesday. Again, this is when the market celebrated the ceasefire news. When it cleared a 2.5% gain, it jumped over 200-day moving average resistance, which is this blue line, and the 50-day moving average resistance, which is that red line. So when you jump over two key resistance levels in one move, one big move, that is very bullish. Now, the S&P 500 closed the day with a 0.1% pullback. That's pretty minor given, where it's come from. But let's just pull back and remember all of these catalysts that it's coming from. All that's happened is that basically, let's take a look here. Let's actually draw the line. Basically, here was the market's close. Actually, let's say, here is the market's close right before the war began. And all that's happened is the S&P 500 is essentially almost finished reversing all of its losses, most of those recognized in March from the war. This is a mathematical, let's just call it a quantitative measure of the market now looking past the war. Now, it hasn't erased all of the gains quite so much, but it doesn't really have to. It's erased or reversed just most of them. Now, on the bad side, all the index has done now has gone right back into this huge period of churn. Remember the rounded top? I took that line out, but let's just call the rounded top invalidated. Now we're back into trading range land, and that won't be invalidated until the S&P 500 can make a new all-time high. Even if and when the S&P 500 makes that new all-time high, I think it's going to be marginal, and then we'll go right back into churning. But it's important to note, this is by the dips, so I expect the 50-day moving average to hold a support for dips. Even if the 50-day moving average gives way, I'm still going to remain bullish on the market and expect the 200-day moving average to hold as support. All bets are off again, of course, if it breaks down below that, but that's not my base case expectation. The NASDAQ, same story. It cleared both key resistance levels after stalling at its 220-day moving average, which is the dash line, and it had a much better move than the S&P 500 because it was able to follow through all the way into the close today, gain 0.4%. It is not close. I forgot to draw. Let's see, where was the war? It too is closing in on reversing all of its gains, all of its losses from the war. But of course, the NASDAQ has this double top that's still in place that it needs to conquer. But the good news is at least the NASDAQ is no longer bearish. Remember, I've been talking about the bearishness in the NASDAQ for a very, very long time. Well, it is no longer bearish, even though this double top remains intact. And again, just like the S&P 500, I expect there to be a lot of price consolidation and back and forth. But again, the psychology of being no longer oversold is that the market is bullish until proven otherwise. So that means buy dips. And when I say buy dips, I'm talking about still respecting all the technicals of support and resistance. Now, IWM, the ETF of small caps, it too hurdled the 50-day moving average, which you can see it didn't even have to hurdle the 200-day moving average because it already held it as support. So the IWM, interestingly enough, was bullish the entire time, long-term bullish, almost the entire time of March and this war period. So its breakout doesn't change the technical outlook, except to say it is now more bullish because it's above its 50-day moving average. But just like the other indices, I expect IWM to churn, pull back a little bit, gain a little bit, and just cause a lot of, push and pull amongst bears and bulls. But importantly, breaking above this 50-day moving average is very important. And I am sorry to say, I did not have IWM calls in place like I should have had when the big breakout happened, but I am going to get right back to buying those call options. Now, I do have to note, one thing I did decide to do, given my expectation for just a lot of churn and trading action, is I finally took profits in my large core position in IWM. I will be looking to add back in on dips, but I'm probably not going to scale it up to as big as I had it before. And this is a strategy that's still developing, so stay tuned on my thinking on this. But I think for risk management purposes, taking my profits on this big rebound just made a lot of sense. All right, let's take a look at the VIX, because the VIX was what I talked about earlier in the week as being the biggest confirmation signal of a bottom. And you can see here, this is the box that I drew in that video. This is a box of consolidation after the blow off top. In fact, I should just label this so it's very clear now. It wasn't clear in the moment that this was a blow off top, but it is very clear now with the confirmation. This was back on March 26th when the VIX gapped way up to 35 and then faded into a 13.5% close. Now, why? I said March 26th. I didn't mean March 26th. I meant this is March 9th. Now, this was very early in the war, of course, so it didn't look like a bottom in the making. And in fact, the market continued to sell off from there. Well, that's because the VIX was able to steady itself before even touching the uptrend. And then it made new closing high on March 27th. And that was when I thought that things could get worse before they get better, even though I saw a bottom in the making. But as it turned out, that was the VIX's closing high of the cycle, and it's been going down pretty much ever since. This is, let me just zoom in here. This is the breakdown below the uptrend. So remember, this uptrend had been in place the entire year. So the VIX has been warning us even before the war that a sell-off was coming. We just didn't know when and how it was coming. Now that sell-off has happened. Now the VIX has given up the ghost. It's below this uptrend line. That is broken. The VIX is no longer warning. It is actually now warming, W-A-R-M-I-N-G. Warming meaning we are good to go for buying the dips. And you can see the VIX continued to fall the rest of the week. It closed the week at 19.2. It's still essentially elevated. We consider 20 to be the elevated level, but it is going down. And maybe at some point I'll be drawing a downtrend line. Wouldn't that be great? Anyway, so the VIX was the confirming signal, and it looks like, it is also confirming the bullishness. All right, let's move on. Let's just take a quick look at a few ETFs and individual stocks. They're going to confirm the point. The biggest beneficiary of the big breakout and recovery are the semiconductors. This is VanEck Semiconductor ETF, ticker symbol SMH. It had a great week, of course. In fact, let's just go to the weekly view so we can just get a reminder of how bullish SMH is. it jumped 11.4% this week. You can see on the weekly basis, it never really lost support of the 20-week line. During the wartime, which was most of March, it never even came close to 200-day moving average support. So it has just been very resilient. And I had some SMH. I think I took the profits here on Wednesday or maybe the next day. I can't remember which one, but it's very telling. SMH is at an all-time high. So guess where we want to look when we're buying dips? We're going to look at semiconductors first, and the rest of the market second. Now, having said that, one of my biggest misses, I talked about how I didn't have calls in place for IWM. Well, actually, my biggest miss of the week was Intel, ticker symbol INTC. I've been talking about Intel. I fell asleep. This whole churn period since January just kind of lulled me to sleep. I think I had one trade in this period, and I just did not have my price alerts in place. Let me just review with you here what I should have done. Right here, you see this breakout? Actually, let me just draw an arrow. This is the 50-day moving average breakout. Right there should have been the time when I said, okay, it's time to start buying Intel again, because it broke out above its 50-day moving average. This was on April 1st when I thought a bottom was in the making. So I had the all clear, essentially, from my trading rules. Then Intel confirmed the 50-day moving average breakout the next day with another 4.9% gain. I think I forgot the news. Next time I cover Intel, I'll talk about the specific news driving this. But you could see what happened after that. Intel's been going straight up ever since this breakout, and it is now overextended. It's well above the upper Bollinger Band, which is that black line that describes about 95% of the price volatility around the 20-day moving average dash line. It's overextended, but buyers keep pushing it. And look down here, you can see the volume is supporting all of this buying. So all I can do is just wait for the dips. So Intel is definitely one of those strong buy the dips. It's in the semiconductor industry, and a lot of those stocks are also buy the dips. Intel just has to be a special one because I had a trading rule in place and I just fell asleep because of all the churn and the trading range that went into that. Micron, ticker symbol MU. This is interesting, right? Because as strong as the semiconductor sector has been, and it's at all-time highs, and it's had a very good recovery, Micron still has this double top in place. So I'm watching this one very closely. This is the double top here, these little half ellipses that I drew up here. So the double top is still in place, but the stock is no longer bearish because look, it did jump above its 50-day moving average, and it confirmed that breakout with a higher close. So Micron is bullish, but it does need to break that double top for me to consider the uptrend back in place and resuming. Another thing I'm going to be watching in terms of buy the dips is the industrial sector. This is ticker symbol XLI, and this is the ETF for the industrial sector. It had a clean breakout above the 50-day moving average. You can see that here. And it too confirmed that 50-day moving average breakout, so it is bullish. I have a small position in XLI. I'm still red on that because I think I bought it right here, expecting the 20-day moving average support to hold. So still some time to go. I should have had it on my list to buy additional shares. You could see this nice bounce right out the 200-day moving average. I mean, I just love technicals. I mean, look at how perfect this rebound was right there, picture perfect. But at the time I was focused on other things, so I didn't add to my XLI shares. But that's again for trading rules, trading lessons. That's another one. Just trust the technicals and use the trade to test out the theory. All right, now let's do some retail or consumer facing names. First of all, Expedia Group, ticker symbol EXPE. Now, as we would expect, it did pop after the ceasefire, 5.6%. But what concerns me a little bit is that it faded hard from its intraday high. So this is ticker symbol EXPE. It went all the way up to 250, but then fell back down and closed at 236.90. So I'm talking about this candle right here. And then you can see it sold off the rest of the week. So it's a little concerning because it's not quite, in other words, this is a stock that I should want to buy given the news, but it now has come back below the converged 50-day moving average and 200-day moving average. Let me just point that out here. And so it is technically breaking down again. Just barely, it's marginal, but it is breaking down. And this is an important juncture because you can see the range is lowering. Let me just draw the lines here. This is going to be a little bit messy, but you can see the range of trading is closing in on Expedia. So this is, I'm going to be watching for what happens when these lines are clearly broken to the upside or the downside. If it breaks to the downside, I'm going to have a lot of questions about consumer facing names, particularly in the travel space. Let's just take a quick look at JETS, which is the ETF for airlines, basically. It's the US Global JETS ETF. It is following the path of Expedia, right? I wanted to show this for confirmation. So here's the price consolidation that happened during the war. This is pretty impressive that JETS didn't continue just going down in a straight line, given oil was going up in a straight line. So that tells you there's some resiliency with the airlines. On Wednesday, it gapped all the way up to, let's call it 27.71, but then it faded all the way back to 200-day moving average support at 26.18, close at 26.18. It's still just barely above this consolidation box, but if it breaks down below that, let's just call that 25.80, then as far as I'm concerned, the travel area, travel-related stocks, particularly airlines and anything that uses oil, is going to be off my list because there's no point in betting against these signals when there's so many other things that are strong in the market, like the semiconductors. So hopefully that made sense. I don't like the fact that JETS is back below both its 50-day moving average and its 200-day moving average. All right, let's look at another consumer-related name. This is EAT, ticker symbol EAT, Brinker International. These are casual dining restaurants. I'm using it as a gauge both of speculation, but also of sentiment in the consumer sector. It, unlike travel stocks, it did clear resistance and it stayed above that and it followed through with two consecutive buying days. Now, if I pull back, just a quick reminder, EAT is in this long multi-year trading range. So yes, it's back in bullish area, but it's not an all clear for buying. I don't think it's really all clear for buying until it can get above the previous peak, which was around 171 right here at this point. And then finally, a ticker symbol ANF. This is Abercrombie and Fitch. I don't think of this as a representative retail apparel stock, but it is one that I have been I traded in and out of, and I was interested to see that it, before the good news on the war, it broke out above, again, let me just make this clear, it broke out above its 50-day moving average and confirmed it ahead of the news. And so I think this one is very bullish, even though it's still in this extended trading range, it's still well off previous highs, and it also fell 4.9% on Friday today. That drop there is not good. But I'll cut it some slack, given how the travel stocks acted and given oil is still high, right? So we still expect consumer pocketbooks to be a little constrained. But if Abercrombie & Fitch gets back to here and tests the convergence, look at that nice convergence. We got all three of the major averages converging. If it comes back to this line, I want to be a buyer. And I should mention that when I say I want to be a buyer or even a seller of a stock, this is all else being equal. So if earnings are coming up, all bets are off on any kind of trade that I talk about for myself. Now let's go to healthcare really quickly. United Health Group, ticker symbol UNH, had some good news on the CMS front. Good reimbursement news, reimbursement for, I think, Medicare, Medicaid. It soared 9% on Tuesday, but it hasn't made any further progress. I'm waiting for a 200-day moving average breakout to get bullish on UNH again. But given the way it's acting, there's a good chance it'll just drift lower until it tests the previous peak, which was here around, let's just call that 295.58. So that's my first place where I might look to buy on a dip. And then, of course, if it breaks out above the 200-day moving average, it's in the all clear as a bullish stock. Now, you may not remember this from previous video, but earlier in March, I believe, I did a scan, and StoneX Group, ticker symbol SNEX, is one of the few that came up strong in my pull, but then it went into this big downdraft once the war started. But the good thing was it did not even come close to testing its 200-day moving average. It broke out again above the 50-day moving average. So now I'm looking good. I think I actually did buy more of this stock because it looked so good on the dip. And now check out where it is at 92.90, ticker symbol SNEX is an all-time high, and it's resuming the uptrend that caught my attention when I think the scan noted it here, and then I bought it on a test of the 20-day moving average. So this is great. This is a perfect stock for buying the dips when I'm talking about the psychology of oversold trading, of the oversold period ending. This is a perfect candidate for buying the dips. I'm actually pretty stunned that it's just gone straight up like a rocket like that, but of course I'm not going to complain. And finally, let's just take a quick look. I keep emphasizing this. When doing scans, there is a benefit to looking for strong stocks. And we expect strong stocks to be resilient. And so when they're strong, particularly during weak market periods, they look even more attractive. And this was a scan I did for all these bullish engulfing stocks. I'm going to do a quick tour to show you what the fate is of all these stocks relative to where I detected them. So just as a reminder, what was that bullish engulfing moment? That was here on March 9th. Now that March 9th should ring in your head. Yes, that was the day that the VIX had that big fade from intraday highs. Now, a lot of these stocks, some of these stocks did have weak moments. And I'm just going to go in order of their performance on today, which is April 10th. So this is Ivanhoe Electric. And I'm just going to go through these really quickly, but let me just introduce you to the concept of what I'm doing. This is one of the stocks that I did select to buy. I'm still holding it. I'm now back to even. So this is actually one of the worst of the performers that I'm going to show you. It's kind of ironic because it fell below its 200-day moving average, went into bearish territory, but now today it has recovered. On Wednesday, it popped 11%, and now it's back above its 200-day moving average. It is definitely not in the all clear, and I'm actually disappointed in how poorly it did during the rest of March, but I'll take it. Now I'm going to go really quickly. I'm just going to call out the ticker symbols that I see. This is form factor form, and you're going to see a pattern, particularly for those stocks that are involved in semiconductors. These stocks are like SMH, are going to be at all-time highs. They're going to be ripping across their upper Bollinger Bands. So hopefully you can see that pattern. In fact, let me just zoom in a little bit more. Here's that bullish engulfing again that triggered the scan. And form was so strong that it never even broke its 50-day moving average, right? That is so impressive. So this is a big candidate for buying the dips because it's just stayed strong the entire time of the market weakness. All right, let's keep going. This is ASX. You see the pattern, held the 50-day moving average. It's ripping. It's not at all-time highs yet, but it looks like it's going to get there. Buy the dip. BHE, buy the dip. AEIS, buy the dip. You're seeing the pattern, I hope. Train Technologies. This is not quite yet buy the dip. It didn't break to an all-time high, but it stayed resilient through all of March. Element Solutions, ticker symbol ESI, buy the dip. Teradyne, ticker symbol TER, buy the dip. Diodes Incorporated, this is one I actually took profits on when it broke out. And let me just take a quick moment. I took profits because I thought it was part of risk management, but as I look at this list of stocks, I wish I could have made these stocks into an ETF. I would have just kept buying. I would have dollar costed average my way into this ETF of all these strong bullish engulfing stocks, and I just would have been happy to sit on it. But since I'm doing individual stocks, that has its own risks that are much higher than having an ETF full of these stocks. All right, this is AME, not yet buy the dips, but you can see it stayed, it did have some weakness during March, but now it's back in bullish territory above 50-day moving average. Q, Yeah, I think this is buy the dips. It held the 50-day moving average throughout March. Caterpillar, buy dips. It's at an all-time high. I actually decided to take profits on my position. I had a pretty large position in Caterpillar. Again, that was just risk management and making sure I locked in some profits off of my fortunate timing on that stock. This is AMAT. I still have a call spread on this that really capped my upside. So I'm not happy about that, of course, but I didn't, how could I know at the time that Applied Materials would do so well? I think it's a 360, 370 call spread, and I'm still waiting to close it out. It should close out next week. But this is buy the dips, buy the dip. RRX, this is Regal Rexnord Corporation. It's not in all clear. It's not by the dips yet, but I am still holding this one. On semiconductor, not quite by the dips yet, but yeah, you see the pattern, 200-day moving average held through March. Cirrus Logic, ticker symbol CRUS, by the dip. Avnet, ticker symbol AVT, it's not quite in the clear yet. I'm still holding this one. And Modine Manufacturing or Modine Manufacturing Company, MOD, ticker symbol MOD. This is a semiconductor play. I actually sold this one in the middle of March, I think. I think I sold it right around here. And I don't think I bought back in at the test of the 50-day moving average, which I really should have done. So now it's buy dips because it's made an all-time high and it's looking good. Kind of interesting that of all the stocks in this list, this ended up near the bottom. Lattice Semiconductor Corporation, ticker symbol LSCC. This is on the borderline, not quite by the dips. And Analog Devices, ticker symbol ADI, not by the dip yet. And Borg Warner, ticker symbol BWA. I'm still holding on to this one. It's still kind of tenuous, but I love how it's held 50-day moving average support. Brunswick Corporation, ticker symbol BC. This is tenuous because it couldn't break out above the 50-day moving average, but it is above the bullish engulfing period. And that is it. I'll put a link to the video if you want to review the case that I made for these stocks. If you have an idea for how to turn this into an ETF, I would love to hear it. I know there's a platform that does that. I don't think it's free anymore, but these set of stocks I would love to put into an ETF and just buy and hold them for as long as the bullishness remains. All right, thanks for hanging in there. Again, put any comments, suggestions down below. Like and share this content so the algorithm knows what's up, and subscribe to the channel. And I will check you out again the next time. And be safe out there. And let's still keep our heads up and pay attention to what's going on. Take it easy.